there, welcome back to Summer Money. Tonight, something a little special. Roger Montgomery from RogerMontgomery.com and author of Value.able is joining us for a value investing masterclass. So let's get right to it. Roger, thanks so much for coming in.
Oh, delighted to be here.
Let's just get started. What's this all about?
Well, I think there's 2 steps or 3 steps really at the most that you need to invest successfully. And people have been, we were talking during the break about my blog and how many people have been going on it and finding really great companies, and they've been doing that because they've followed the steps, and it's really not that difficult. It's not, I should say this, it's simple, doesn't mean it's easy, you know, there's still personal temperament involved, but the 3 basic steps are simply to understand how the market works, understand the difference between an extraordinary business and a mediocre one, or a good business and a bad business, and then know what to pay for it. And if you do those 3 things and you do them consistently throughout time, then you're going to find that you're going to be able to beat the index. And the reason I think it's actually quite easy to beat the index is the index is full of rubbish. If we can just remove the rubbish, then we should be able to do better over long periods of time than the market. Because the market, remember, is measured by the index. It's got a lot of garbage in it, and we're just going to cut those out. That's the first step, and that's what I'm going to show you tonight.
Okay, so tonight's about education, and it is about separating good businesses from bad businesses, because I guess there are a lot of bad businesses out there where you're not going to get value for money.
Well, I can tell you, I track every single company listed on the Australian Stock Exchange, and 1,199 of them earned no money last year. So 1,199 out of about 2,000 companies didn't make a profit. And so they have a value for that year of 0. And so if we can just remove the rubbish, if we can get rid of the bad companies and focus on the extraordinary businesses and value those and then buy those below their value, I think we're going to do pretty well.
Okay, I'm excited.
All right,
Tell us how to do this.
All right, well, let's go to the first slide. So if we have a look at this slide here, this is a mystery company. I'm not going to tell you what this is, Nadine. Now, if you have a look at the first column there, the year 2000, I want you to imagine we're going to start a business together, and we're going to put in that equity, that $2.8 billion or $2.9 billion of equity.
So this is money that's coming from shareholders' equity.
Exactly. It comes straight out of the balance sheet, but for the purposes of our example here, it's money that you and I have contributed to kick the business off. Now, we also go to the bank, and you can see that in the debt in the last row there, and we go to the bank and we borrow $3.1 billion. And so that's what we're going to kick the business off with. Almost $3 billion of equity and a bit over $3 billion of debt. And in the first year of operation, we're going to make $517 million profit. So after a year of running the business and contributing almost $3 billion of our money, we've made $517 million profit. Now, do you think that's a good result or a bad result?
Oh, that's a pretty good result.
It's not a bad result, and I've measured it there by return on equity, which is the ROE row. So that's 17.5% on the money that we've contributed. Now, you can't get that in a bank account. I can't get that in a bank account. That's a pretty good result. So encouraged by that, we decide to keep going. We're going to run this business for 10 years.
All right.
So fast forward 10 years, we're at 2010 now, and we make a profit of $267 million. Now, I should say that's a forecast. That wasn't the actual number. The actual number was only about $130 million. So let me ask you the first question. If you started a business 10 years ago and it made $517 million, and 10 years later it makes $267 million, good or bad?
Pretty bad. I'd be asking what went wrong.
Yeah, well, after inflation, it's even worse than that. You're really, your profit has fallen, and after inflation, it's even worse. Now, so it's bad on the surface, but that's not the full story. In addition to that $3 billion that we put in at the start, we've also put in another $3 billion.
Okay. So
you can see that over on the right-hand side. We've added, over the last 10 years, another $2.933 billion. So now we've contributed $5.8 billion, and we're getting a profit, you can see, using those numbers, you can see is about half of what we were getting 10 years ago. Good or bad?
Yeah, not very rewarding.
Not rewarding at all. It's terrible. And in fact, your return on the money that you've put in now, the return on the total money you've contributed, is 4.6%. You can get a better return in a bank account for no risk.
Absolutely. So I don't think we should go into business together if it's going to look like that.
Not if it's going to be that business, that's right. So pull the slide back up, because there's one more piece of information I want to show you.
Okay. And
if you have a look at the debt, in the last 10 years we've gone back to the bank multiple times and we've put in an additional $2.4 billion. Now the next slide, what I'm going to show you is what this looks like graphically.
Okay.
And I call this is Montgomery's chart of shame, if you like. This doesn't look very good. So the green bars that you can see there are our profit. That's the profit back in 2000 and the profit in 2009. The grey bars, they represent the equity that we've put in. So the equity back in 2000, what we've contributed since. The red bars and the red bars are the debt. So what we've contributed in debt, or what we borrowed from the bank 10 years ago, and what we've got borrowed from the bank now. And in that time, the return on equity has dropped from almost 20%, 17.5%, down to 4.4%. That is what a bad business looks like. You wouldn't want to own that business. That business is losing money for you. So the more money you put in, the less profit you make. And that's the picture of a bad business. That isn't an extraordinary business. That's not a business that I'd want to own. Now, this is a real listed company. This isn't it's not a make-believe business. It's a real business. If we go to the next slide, you'll see what business this is.
Is this a business that a lot of Australians perhaps are invested in?
This might be a business people are invested in. This is a business I'm sure everyone knows. So let's have a look.
All right,
now
let's find out what
slide.
this business... Oh,
this is Qantas. So this is an airline. Now, Warren Buffett said something about airlines many, many years ago. He said if he'd been at Kitty Hawk in 1908 when Orville and Wright took off, he hoped that he would have had the foresight for the benefit of all capitalists to have shot him down, because airlines have lost billions and billions of dollars, and Qantas is an example, and it's a star pupil in the airline business in the world. Yet more money's been injected, more money's been contributed. The debt that you can see is the on-balance sheet debt. We're not looking at the off-balance sheet debt. The debt's gone through the roof. We've contributed more money and we're earning less than we were earning 10 years ago. Now, what's the point of doing this? There's not much point, really, in me telling you all of this if there's no relationship between the performance of the business and the share price. Because if the share price doubles, triples, quadruples over 10 years, or goes up even more, then it doesn't really matter whether it's a good business or a bad business. But Benjamin Graham said something really interesting many years ago, and Benjamin Graham was Warren Buffett's mentor, and he said this, he said, in the short run, the market is a voting machine, where the voters register their votes every day and they are neither emotionally stable nor intelligent. So in other words, in the short run, prices are moving around and being pushed around by investors and traders and people who aren't emotionally stable. And so the share price might bear no resemblance at all to the performance of the business. But
and the fundamentals.
And the fundamentals. But he said in the long run, the market isn't a voting machine. In the long run, the market's a weighing machine. In the long run, price follows value. So if we pull up the next slide, we'll see whether or not that's true, whether there's a relationship between price and value over long periods of time. So let's go to the next slide.
Ben Graham's weighing machine. So this is a name that we should get ourselves familiar with.
Yeah, and there it is. Now that brown line that you can see running across horizontally is the intrinsic value, is my intrinsic value for Qantas, and it hasn't actually changed in 10 years. And what you'll notice about the share price is the share price hasn't changed in 10 years either. So just as the performance was pretty bad, if you'd owned the business outright, when you take that business and you list it on the stock market over long periods of time, the share price performance is going to reflect the performance of the business.
So, Roger, when you talk about intrinsic value, you're talking about the actual value of the company based on underlying perception of its true value, and that's including, you know, tangible and the intangible as well.
We're going to talk about how to calculate intrinsic value in just a moment.
Excellent.
But it's based on the performance of the business. It's not based on the share market. And you saw with that chart that the share price went up in the short term and it went down, and that spike that you saw where the share price for Qantas rose, that was during the takeover. You might remember Airline Partners Australia made a bid for Qantas, and some fund managers, or a fund manager, decided that it was worth more, and so kiboshed the bid, and then the share price thought it was worth more, but the share price actually slumped, and over long periods of time the share price will reflect the performance of the business. So it's worth our while understanding whether a business is a good business or a bad business. So what we're going to do next is we're actually going to go through the process of looking at Woolworths. We're going to assess whether or not Woolworths is a good business or a bad business.
This is Sky News Business, Australia's business channel.